Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon daily webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, myself, or Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer while we welcome Dimitri Pargamonik to the stage, who's going to talk about option volume graphs. Welcome, D.
Good morning, Will. How are you?
Great.
Let me share
your screen. There you go.
Good morning, everyone. And today we'll go over a quick way to look at an option volume graph for a particular expiration. So if you're looking at a certain stock and you see the option volume breakdown and you just want to visually see what's going on in that expiration, we could draw some graphs to give quick insights. So let's do an example here. Let's pick something like Google. Let's type in Google in our search box, and this will take us to Google's main summary page. And on the left-hand side, we have this menu. So let's click on options, and under options, let's click on activity. And I'm going to then click on this menu to minimize it and expand our screen. And here we first come to this page, which gives us this option volume breakdown. And we have this table that is organized by expiration month, starting with the most, the closest expiration to maturity and going out further. And in the beginning, we have the summary statistics for all the option volume. So this is taking all the option volume in aggregate that traded in Google. So we see 81% of all the option volume were single leg trades, which means either a call, either buying or selling a call or a put. 18% of the option volume was entered and executed as a multi-leg trade, like a call spread. It could be iron condor, butterfly, and then less than 1%, 0.6% of the volume was contingent, meaning that there was another component tied to it, like a stock. So entered in, let's say, buy right. That would have been a contingent trade where you need a stock and option execution. And underneath each one, we have a breakdown of the call versus put. So in single leg trades, 47% were calls, 53% puts. Multi-leg trades, 70% were calls, 28% puts. Contingent, 4% calls, 96% puts. And this tells us how the trades were executed. So almost all of them were electronic. A small percentage was a floor trade, meaning there's a human touch with a broker. So if we come down here and we see all these option expirations, September 26th, October 3rd, October 10th, and going down, we have these data elements. And if we come up to here we see the volume for each of these expirations. So it's really quickly, you could see, you could eyeball and just see any volume that stands out, like 96,000 for September 26th, October 3rd, 22,000. And to make it easier, here we have a breakdown of what percent of the total volume fell in that expiration. So 53.7% of all the volume traded in Google was in the September 26th expiration. Then 12% was in October 3rd, and so on. So if anything, and that's probably something that you typically see, most of the volume is in the shorter dated options. That's how traders have been using options. If we look at other even similar type of securities from day to day, but sometimes you'll see something different. So here, we do get a breakdown. Sometimes you might see a little bit of a pop somewhere out in the longer term options. And let's say, we might be looking at a particular expiration and wanted to see that breakdown. Maybe, we're interested in November 21st, and we see that there is some trading interest and activity, and there are 11,898 option contracts that traded. And if we want to get quick insights, where was that trading activity? Where did how did it look like throughout the day? If we click on this, we'll get a few charts that will pop up below. So you see here, I clicked on it, so that will pop up below the table. And you can see here, November 21st is the expiration I clicked on. And here we have something similar to what we just did in the aggregate, a breakdown of single leg options, multi-leg, and contingent in that expiration. So this is only looking at the volume in November 21st expiration, a breakdown between calls and puts in each of these categories. So for example, multi-leg trades, we see 87% of those were involved call options. And we could also see that similar to the aggregate volume, most of these were executed through electronic executions, which means when you're entering orders through your broker, they get routed, then they go through a matching engine and get matched up. So they're automatically executed using electronic execution. Right? So there aren't manual brokers involved in the transaction. In addition, we might ask a few more questions just to get idea, where did that trading interest, how was it distributed on the different strikes? Because we have option volume in a particular expiration, but that expiration could have a lot of different strikes. And how did that look like? And here we have a breakdown within November 21st, the volume, 40% were puts, 60% were calls, and these bars reflect the volume on each of these strikes. So the yellow is the call volume, the blue is the put volume. So if it's on the same strike, you'll see them stacked, yellow for calls, the put volume on top of it. So here, really quickly, we see the 250 strike had the most trading volume, followed by the 175 strike. On the 250 strike, we see most of that volume were in the puts, 2,327 puts traded on the 250 strike versus 548 calls. If we look at this bar, we see on the 175 strike, it was mostly calls, 1,996 versus 5 puts. And if we look at maybe some of these higher strikes, we see mostly call volume trading on these bars. The yellow ones stick out more than the blue. And if we go down, we see a little bit more of the blue. So as we go up in strikes, more call trading. As we go down in strikes, more put trading until we get to this one big 175 strike. So now we quickly get an idea how the volume and trading interest traded on that day relative to strikes. Another thing we could take a look at is how did that trading interest, how is it distributed throughout the day? Do we see, a few big trades throughout the day? Is there, fairly equal amount of trading going on throughout the day? how does that volume profile look like? And this gives us the volume based on 5-minute bars. And this could help us because now we see big spikes in certain periods of the day. Here at between 10:50 and 10:55, we see 1,219 puts traded, which was a big spike for that expiration. Here we see a bunch of calls traded between 140 and 145, 900, followed by another 500 between 145 and 150 p.m. Eastern. And this lets us, when we look at as traders, time and sales, we look at the trades, but time of those trades can be significant because when we spot the time, first it allows us to then identify when these trades occurred. So we could go back to the time in sales and look at those trades deeper. What were other surrounding factors around that time that could have explained some of this trading activity. So we could correlate it with maybe news. We could correlate it with maybe other trading activity in similar products or similar securities, maybe to the rest of the market, because it's not important just to see those trades, but to be able to research and explain what might be happening so it makes sense, right? If was this just a random trade that that came in, or was this part of something that could have been happening around that time, and explains that part of the trade, so we could understand how people are using options, how they might be positioning themselves, and why. And that plays into the price discovery and just to understand the dynamics of that trading activity in that security. In addition, down here, this looks at the volume in this particular expiration going back in time. And typically what you will see is that the volume starts to increase more and more as it gets closer and closer to expiring. So as we get closer, so you have a option that expires November 21st, but eventually we'll get to November 21st. It's going to be a 0 DT and expire, right? And that option will go away. But we could go back in time and see how much trading interest in this expiration leading up to it, and if it follows that path, or we do see it in September 3rd, something happened in this November 21st expiration where we saw a big spike in trading volume, then it kind of dipped here, came up again, dipped here. So there is something here that is interesting where we've seen a historical spikes in the trading volume where there could be people positioning themselves in anticipation of something. Could be earnings, it could be some kind of news, but we do see some interest there that looks a little bit like not what typically you see is just like as you move closer and closer and closer to expiration, it just keeps going up in a steady kind of line. So that could be important because we could go back now to September 3rd, and now that we spotted this, and kind of see, well, what was the trading activity that day, and did it lead to an increase in open interest somewhere, and is that open interest is it still open, not closed yet, right? So we could kind of see that, what type of positions and how traders were positioning themselves, and how does the current open interest look like in this expiration. And just really quickly before I move on, if we wanted to just go to that November 21st expiration, and we clicked on the volume, but if we just look at the open interest, 114,000, and we click on that, we'll get another graph of the distribution of the open interest by strikes, calls versus puts, stacked up, and how that open interest climbed or declined, how it looks over time. So you could see it keeps building higher and higher and higher, meaning more and more people who are trading in this particular expiration are holding on to their positions as this open interest climbs. So I'm going to stop right there. I want to give that brief overview of how to look at that trading volume in a quick graph to get those insights.
Yeah, that was a great webinar, D. Thanks for bringing it to us. Hope you had a great holiday, and we'll see you tomorrow, Friday.
Thanks, everyone. Stay safe out there. Have a great trading day. Get to see you tomorrow.
All right, D. Have a great day. Bye. Hey, everyone. Thanks for joining the Market Chameleon webinar series. Remember to like and follow us on all the social platforms, particularly if you're on YouTube. Thumbs up. Wait to the end. I'm going to show a special picture from one of the chameleons who is trying to get through some surgery. But before we do that, I just want to add this to the stage so everyone can take a look if you're here for the first time. There is a free trial you can take on Market Chameleon. Click free trial, 2 spots here or here, and give it a try. And we'll end with Swami's breakfast, a little tequila. Feel better, Swami. Hope all is well with everyone and have a safe trading day. And everyone, prayers and thoughts to Chuck. All right. Have a great day, everyone. Bye-bye.